information for Khind Holding Berhad. Khind Holding Berhad is a Malaysian public company that manufactures, trade and distribute electrical home appliance, wiring, accessories, and industrial electrical products. Founded in 1961 in Khind, Selangor, it has transformed from a small electrical repair business into multinational organization. Executive Chairman Mr. FIN658 and Group Chief Executive Officer is Mr. Adil Jimmy Mistri. Market capital for Khind Holding Berhad until December 2025 was of 60.12 million. Its market capital has decreased by negative 47.05% in 1 year. However, since 2001, Khind Holding Berhad's market capital has increased from 53.057 million to 60.12 million, and increased by 11.95%. Number of shares Khind Holding Berhad is approximately around 42.04 million shares, which represent the total issued shares held by shareholders during the periods under review. Sharia compliance. Yes, Khind Holding Berhad is under Sharia compliance company. This calculation shows that the company's main business is active and financial setup follow Sharia principle. As a result, it is suitable for investment by Muslim investor and Sharia-based investment fund.
Next is year-to-year change analysis. This chart shows the year-to-year changes in the company's financial position from 2022 to 2024. In 2022, the company experienced a decline in assets and a significant increase in liabilities, indicating financial pressure during the year. In 2023, the decline became much smaller with lower reduction in assets and liabilities, suggesting that the company's financial position was stabilizing. In 2024, the company showed a strong recovery in assets, but this growth was mainly funded by higher liabilities, while equity declined. This indicates that growth was achieved through debt financing, which increased financial risk. Next, looking at revenue and net profit. Revenue remained relatively stable over the 3 years. However, the net profit declined consistently even in 2024 when revenue improved. This suggests that higher costs or financing expenses affected profitability. Overall, the company moved from financial stress in 2022 to stability in 2023 and then to debt-driving growth in 2024. While performance showed improvement in size and revenue, profitability and cost control remain key concerns. Next, I will discuss the common size analysis for the financial position. The company is highly concentrated in current assets across all 3 years. This indicates a strong short-term asset base. However, current liabilities increased significantly in 2024, while equity declines, suggesting higher reliance on short-term obligations to finance operations. Non-current assets and non-current liabilities remain relatively stable, indicating no major long-term investment or financing changing. Overall, this trend suggests increasing liquidity pressure and weak capital structure, especially in the most recent year. Next, I will discuss the common size analysis for the profit and loss statement. From 2022 to 2024, we can see that the cost of sales is decreasing, which suggests some improvement in cost efficiency. However, this positive trend is offset by a steady increase in operating expenses over the 3 years. As a result, the net profit margin shows a continuous decline, reaching a very low level in 2024. This indicates that although the company managed production costs better, higher operating expenses are significantly eroding profitability. Overall, the company's cost structure is becoming less favorable for profit generations. In conclusion, the common size analysis shows declining profitability due to increased operating expenses, while the financial position indicates higher reliance on current liability and lower equity in 2024. This suggests increasing financial pressure in the most recent year. Based on the index number trends, revenue decreased after 2022 and show only a small recovery in 2024, indicate weak sales growth. Net profit decreased sharply each year and reached a very low level in 2024, showing weaker profitability. Asset and equity remain relatively stable, while liabilities increased in 2024, indicating higher financial risk. Overall, the index trend showed that the company's performance is weak mainly due to lower profitability even though asset level remains stable. Now we proceed to the financial ratio. First is liquidity ratio. The company's liquidity position improved in 2022 and 2023 with both the current ratio and asset test ratio at comfortable levels, showing good ability to meet short-term obligations. In 2024, liquidity weak as both ratio declined due to higher current liabilities. However, the ratio remained above 1, indicating that the company could still cover its short-term liabilities. Next is solvency ratio. In 2023, the decline in the debt ratio and debt to equity ratio shows an improvement in the company's solvency due to lower borrowing and stronger equity. However, in 2024, both ratio increased, indicating higher reliance on debt financing. This raised long-term financial risk, although the company's debt level remained at moderate level. Next, efficiency ratio. The company's efficiency declined over the period. Total asset turnover decreased from 2022 to 2024, showing that assets were used less effectively to generate sales. Inventory turnover also fell, indicating slower inventory movement. Overall, this suggests weaker operational and inventory management. Lastly is profitability ratio. The company's profitability declined over the period. Return on equity decreased each year, showing lower returns to shareholders. Return on asset also fell, indicating weaker ability to generate profit from assets. Overall, this shows a clear decline in the company's profitability.
Assalamualaikum, my name is Nur Anizabati. I will explain about stock performance. From 2022 to 2024, Khind Holding Berhad show mixed performance trend. Dividend payment and ADS increased from 0 in 2022 to 10 cents in 2024, reflecting a more shareholder-friendly stance. However, EPS declined sharply from 43.3 cents in 2022 to 3.52 cents in 2024, indicating weakening profitability. Despite the fall EPS, the closing share price remained relatively stable around Ringgit Malaysia 1.85 cents in 2022 to 2023 and only slightly dropped to 1 ringgit 0.65 in 2024. This mismatch between falling earnings and relatively stable price caused the PER to surge from 7.43 times to 65.60 times, signaling highest valuation rates. Meanwhile, BVPS remained relatively stable around Ringgit Malaysia 4.89 to 5.0 cents, showing that the company asset backing is solid despite decline earnings.
Operating cash flow. In 2022 until 2023, the company has shown a positive value. However, in 2024, the company has shown a negative value. This shows Khind are good in their operation from 2022 until 2023. However, in 2024, the company faced a large outflow. This indicates that the year 2024, they are weak in their operating performance and their business failed to generate more cash. Cash flow for investing in activity. The company has recorded a negative value for 2023 and 2024. The company has spent much on investing activity to generate higher revenues for both years. Business spent a lot on acquisitions, even though Khind receives cash from selling their investment, but the amount cannot cover cash outflow of buying another investment. This consistent capital expenditure indicates Khind is focused on asset expansions and through capital investment. Cash flow for financing activities. The company has recorded negative financing cash flow for 2022 and 2023, which means the company relies on its term debts and issuing the share. Repayments on bank quite high for year 2022, while in 2024, financing inflow amount RM 29.8 million, and this means the company received funds from new borrowings.
Here is the pro forma statement of the Khind Group Holdings Berhad. The pro forma income statement for 2025 shows a slight improvement in performance based on a 2% increase in revenue. Gross profit increases in line with sales, indicating that cost of sale is well controlled. Operating profit also supports from the retained earnings and internal funding. Whereas on the side to profit and loss statement 2025 and 2024 and 2025 forecast, we can see that we able to see that the pro forma balance sheet for 2025 shows a stable financial position. Total asset increase in line with the assumed growth rate, with both current and non-current asset growing evenly. Equity remains stable, while liability increased at a similar pace to support asset growth overall. The company maintains a balanced capital structure and stable financial position in 2035.
Firstly, based on the price chart, Khind is currently in a clear downtrend with the price trading near its recent support levels around RM1.25 to RM1.33. This suggests ongoing selling pressure and weak market sentiment, indicating that the stock has not yet shown the signs of a strong recovery. Moving on to the MACD indicator, both the MACD line and the signal line remain below the zero line, which confirm bearish momentum. Although there is a slight narrowing between the two lines, it does not yet signal a strong bullish reversal. Therefore, this supports a hold to sell or cautious hold position. Next, the rate of change shows a small positive value of approximately 0.7%, suggesting a minor short-term rebound. However, since the ROC remains close to the zero line and follows a previously negative trend, it indicates weak momentum and does not confirm a sustainable upward movement. As a result, the recommendation remains to hold unless stronger momentum develops. Looking at the stochastic percentage, both K% and D% are below 20%, placing the stock in the oversold region. While this may suggest a potential short-term rebound, the lack of strong confirmation from other indicators means that this signal should be treated cautiously. Therefore, this supports a hold rather than an immediate buy. In conclusion, the majority of technical indicators, including price trend, MACD, ROC, and stochastic, suggest continued weakness with limited signs of reversal. As such, the overall recommendation for the investors is to hold the position with a bias towards selling if further downside confirmation appears.
This is now summary. This is here I would present the summary of the Khind Holding Berhad. As we can see from all the analysis we have done, from the year from 2022 to 2024, Khind Holding Berhad shows stable but weakening performance, with sales remaining steady while profit declined sharply. Profitability indicators such as EBITDA, net profit, ROE, and ROA all fell, indicating lower efficiency and weaker asset utilization. Despite of this, the company's financial position remains sound, with a current above 1 and low debt level suggesting manageable financial risk. However, declining EPS and unsustainably high dividend and a falling share price reflect weak investor confidence. Overall, the company is not in financial distress, but its performance is underwhelming and less attractive to growth-focused investors unless profitability improves.